next, we have a conversation with India's leading authority on the economy to tell us the role of Fintech in rebuilding India's economy. It's time for a fireside chat. So please join me in welcoming on stage Dr. Krishnamurthy Subramanian, the Chief Economic Advisor to the Government of India, and Shweta Rajpal Kohli, the Head of Public Policy for Sequoia Capital, India.
Thank you so much, and it's an honor and a privilege for me to host Chief Economic Advisor Krishnamurthy Subramanian at Razorpay FTX to talk about how Fintech is rebuilding India. But before we dive into Fintech, I think no one better in this country than CEA himself to tell us the state of the economy. Dr. Subramanian, you've talked enough about how we're going to see a V-shaped recovery. Tell all the people who are watching us here today at Razorpay FTX a little more about why you've been so bullish on the fact that India will see full recovery coming in.
Thank you very much, Shweta, and very happy to be here talking about Fintech, something that I really love. As an engineer that ventured into economics, this is something that is really close to my heart. On the V-shaped recovery, if you would recall, after the first Q1 GDP print, in all my media interactions, I had mentioned that looking at the high-frequency data, the V-shaped recovery is indeed on. Now, that was based on a couple of fundamental principles. One, what we were seeing is that up until February, the economy indeed had actually, had been picking up momentum due to the measures that were taken. Now, the Q4 GDP print, of course, came lower. That was because, the COVID pandemic affected India badly starting March itself. And so the Q4 number actually was lower, and what we had clearly, seen is that counterfactually, if, for instance, the pandemic had started infecting India in April, the Q4 number would have been far better, and actually the economy would have started turning around. That was point number one. The second point was, in that point, what was embedded in was that this slowdown, the first Q1 slowdown, or the decline, did not have anything to do with the slowdown that was happening because the economy was gathering momentum. Secondly, the impact on the Q1 was primarily because of the restrictions imposed on the lockdown. And that is something, when we plotted the restriction, the stringency of the lockdown as measured by Oxford University versus the April to June quarter GDP numbers, India exactly lied on the line of fit. And so we said that this was completely because of the restrictions. Therefore, then the conclusion from that therefore was that once the restrictions are taken out, actually the recovery should happen. And that was what was being indicated in the high frequency charts as well. Now, when you see yesterday's IIP print that has come in, and now Y on Y almost 4% growth. And the other indicators, consumer durables, for instance, has recorded now high double digits. And consumer durables is actually an indication of discretionary spending, which is a very important part of consumption. Consumer non-durables, overall consumption, investment as well. And I think in the Q2 numbers, what really pleasantly surprised me was that investment increased 60% Q on Q, quarter on quarter. Typically, investment lags behind consumption, but that was also something that was, so, if you look at the charts for durables, consumer non-durables, consumer spending, investment, you see these everywhere, which is what I basically talked about. And I think that is indicating the resilience that the Indian economy had, and the fact that the Q1 decline was only because of a pandemic, a once in a century event that we are all going through.
Clearly, V is that one letter that everybody wants to see when we talk about how the economy will look like. And I'm glad that you at least sound very, very confident that India is going to be back on the path of recovery, and the worst possibly is behind us, even though, yes, we understand we're still entering 2021 with tons of uncertainty. Let me now talk a little more about Fintech, because today, thousands and thousands of people from the Fintech industry are watching you, and they would love to hear your perspective on how the Fintech industry is scaling India's growth.
I just want to give a little bit of personal background. I think it may interest the viewers. Back when I was doing my BTech dissertation, I had actually worked on the application of neural networks in electrical engineering. And today, what you see in artificial intelligence, machine learning, all of these actually are, have taken significant advances. But all along, I have actually been believing that these kind of technologies are ripe for implementation in the finance industry. And if you reflect on the two key problems that the Indian financial sector faces, I think both places fintech can play a significant role. Firstly, it is an aspect of quantity, which is the fact that reach of credit is actually far lower. To give you some statistics, the private credit to GDP ratio for India is about 52%. The average for OECD economies is 3 times that, almost 165%. So we are actually far behind on that. That's point number one. And something that fintech is really helping already, reach a lot of, hitherto credit rationed, people. The second problem where fintech actually can play a significant role and is not yet doing enough is on the large corporate credit, on quality of lending. If you look at the quality of lending and the NPAs over the last 3 decades in India, the NPAs have come, all of them, in the large loans. And there's a significant pattern to it, something that we can discuss going forward. Use of related party transactions, bad financial statements, all these are aspects that can actually be tracked down by fintech. In the economic survey chapter on golden jubilee of bank nationalization, we'd actually shown how even 4 or 5 years before the 30 dozen were identified as these defaulters, the indicators were very much there about such kind of. So this is another main area where fintech can play a big role by bringing together disparate data sets, not only to estimate the ability to repay, but more importantly, the willingness to repay. And I think that is now significant advances are happening in that, in being able to find out the willingness to repay. And conceptually, we economists think about, when we talk about credit in general or financial services, we talk about the adverse selection problem and the moral hazard problem. Moral hazard is a much bigger problem in the context of large corporate lending, and that's where fintech can play a big role. And I think I can lay out the details, subsequently, if you will.
So that's absolutely fascinating that you talk about that as an area of growth for the fintech sector, because it is important now that the fintech industry goes beyond plain vanilla digital payments as an area of growth. But I would like to focus a little around the kind of spurt we've seen in digital payments, especially during the pandemic. It's true that some sectors were hit very badly, but I think that one sector where we've seen tremendous upswing is perhaps digital adoption. Today companies like Razorpay empowering millions and millions of consumers, millions and millions of small businesses, to adopt digital tools, to adopt digital payments. I'd love to hear your thoughts around whether you think this is a trend that will continue as we move into a post-COVID era.
No, absolutely, Shweta. I think before talking about the significant opportunities that fintech has created in this, it's also just important to take a pause and look at what the digitization of the economy really provided as benefits during this pandemic, when we needed to have social distancing maintained amidst the lockdown. Just to give you what could have been if, for instance, we had an infrastructure that was 5-6 years, the kind of thing that we had without the digitization, without the jam trinity. In the United States, what they had to do was they had to print checks, physically mail those checks through the United States Postal Service. People who got those checks then had to go to their bank branches, or maybe the ATMs, to deposit those checks and then withdraw the cash. So 4 steps. India did this in 1 step through the click of a button, and thereby was able to actually avoid all the long queues that would have been inevitable, if we had an infrastructure that was actually 6-7 years old, if we hadn't invested in this. And then think about the social distancing, the spread of the pandemic that would have happened. I think that's just mind-boggling, the kind of impact that we've been able to have just through the digitization. Now, on top of this is where I think fintech is really taking off, because as Joseph Schumpeter used to say, creative destruction is actually what is so critical in a capitalist economy. And I think what fintech and the digital economy is bringing is that creative destruction. Now here I think there are important learnings to have from microfinance, which fintech can take further on. If you take, for instance, a UPI, right? What's the benefit that you can make recurring payments and you can make it frequently? Why is this important? Because the important learning from microfinance is, if you have a product that really fits to a T the cash flow streams of people at the bottom of the pyramid, then that product is a winner. Because if you look at the nature of cash flows, people like you and me, we get our salaries at the end of the month. But people at the bottom of the pyramid will typically either get maybe daily wages or weekly wages. Their cash flow inflows and outflows are far more frequent compared to us. Even when they buy things, for instance, they'll buy a small shampoo sachet, while we will go and buy a big shampoo bottle. And that's where the difference is. So when you use something like UPI, which can enable recurring payments, maybe weekly payments or bi-weekly payments, that can make a huge difference in actually providing credit to hitherto sections of people that could not avail. And that's where fintech is really doing a lot of good work. MSMEs in particular, by bringing together data, GST data, the account aggregators, bringing them all together, the kind of alternative credit scoring models that can now be employed, so that lending is not just based on collateral, but also based on cash flow. I think, for a sector like, for a country like India, with almost 60% of the value added coming from services, where collateral physical assets are not as important, cash flow based lending becomes very, very critical. And that's where fintech can play a big role in enabling MSMEs to get that credit. And I think there is enormous scope for doing this, because one of my concerns has been that if you look at quantum of MSME lending as a percentage, the traditional banking channels have really not reached that much. And fintech now needs to disrupt and really sort of push the traditional banking sector to respond to these challenges.
Right, and that brings me to the next big area we'd love for you to talk about, and I know it's something that's close to your heart as well. When we talk about traditional banking channels not fulfilling a lot of what is desired, your thoughts around neo-banking and how that will be a trend that will probably be the most significant one for the fintech industry, in fact, for the entire financial services space.
No, it's very interesting you asked me this, Shweta, because a couple of years before my PhD, I worked with ICICI. This was when it was not a bank, and it is also sort of a signature of the kind of forward thinking that institutions like those used to have. I actually worked on the idea of a neo-bank at that time. It wasn't called a neo-bank, but an online bank. But of course, I think this was the time when the tech boom was happening. The advantage that such an entity brings, and this I'm drawing on some of the work that I had done at that time, almost 2 decades back, is that it basically can have really low costs, because you don't have any physical branches. You don't have to actually take care of all the costs that are involved in physical branches. Plus, when you overlay on that the significant analytical models that can be deployed, and there's now research by the Bureau of International Settlements, which I was reading with a lot of interest, which shows that these kind of online credit models can not only be much faster, they can actually be cheaper, and more importantly, they can also do financial services, especially credit, with much less default. And which is, I think, so in some sense, it's a win-win in many ways. And by collaborating, the neobanks collaborating with the banking sector, I think there can be a lot of advantage that can be generated, especially I would say on the large corporate lending. Because this is one area where, if you have these neobanks who are actually, let's say, liaising with banks, bringing data together, and really estimating not only the ability to repay, but the willingness to repay. using related party transactions, etc. I think there can be huge amount of benefit that can come. I actually want to lay out some specific research that I've done when I was part of the Uday Kota Corporate Governance Committee at SEBI. We'd actually looked at the quality of disclosures of related party transactions, and we had done this among the NSE 500 entities. So it's quite informative because this is where I think a lot of disruption can happen. That the advantage of related party transactions, it's like double entry bookkeeping, because if entity A does a transaction with entity B, both A and B must be disclosing it. And so you can go and check that. And this is where FinTech can do it. You can use machine learning algorithms, for instance. But what we found was even among NSE 500 entities, only 1/3 of the transactions actually match. 1/3 of the transactions, one of the entities does not disclose. And in the other 1/3, the two entities disclose, but the seller typically underreports and the buyer typically over-reports. And you can see why that is the case. Now, this kind of thing matters a lot for default because it's related party transactions that are actually at the nub of willful default. When you bring these together, quality of disclosure on related party transactions and tracking of those using network analysis that is possible, fintech and neobanks can play a big role, in really enabling banks to basically, make good on the large corporate lending. Because if we can really take care of large corporate lending without the periodic NPAs, the accelerator break problem, then I think, a big concern in the Indian banking sector is solved.
I think that's a very, very important thing you've mentioned, and specifically one area that you talked about, and which is the collaboration between the traditional banks and the fintechs and the neobanks, as well as I would put in a third pillar there, the regulators. I think for this to be absolutely successful, we require all three to come together, and that collaboration will perhaps be the recipe for success. Your thoughts again on how we can make that a reality?
So I think that is actually absolutely well said, that see, across sectors, whether it's finance, whether it's the real economy, typically it is the new entrants that actually bring in disruptive models, be it disruptive products or disruptive organizational models. It's always the new entrants that bring that. And therefore, I think competition is actually incredibly important in enabling, this disruption to happen, especially the financial sector. Again, I'll give you a factoid. Take the United States, which has a population which is 1/4 ours. The number of banks that they have, almost about 30,000 banks. India, with a population that is 4 times that of the United States, has about maybe 100 or 1/500 of the number of banks. And this is important because a large number of these banks in the United States are small banks that cater to small borrowers. This small bank, small borrower pair is incredibly important for credit to actually penetrate, because they bring not only quantitative information that comes in, through data, they also have good qualitative information. Typically, they are on a first-name basis with the borrower, to understand the character of the borrower, and those are important to also complement with the data that comes in. So I think this is one area that really we must be thinking of enabling, and this sort of triangle of entities must really collaborate to push, and thereby exploit the enormous opportunities that there exist in the financial sector now.
Right, and while we talk about this, we totally understand that regulators and policymakers have their own priorities, and there are concerns as well. But certain policies like zero MDR, for instance, are the ones that seem to be hampering the growth of the fintech sector. Your thoughts around how policies and regulations need to keep pace with the kind of growth we're seeing with technology and with innovation, and they need to be enablers more than being blockers.
No, I think, without getting into the specifics, because there are a lot of nuances that are involved, in these aspects. What I would say is, that we need to actually enable far more competition in this area. But at the same time, one of the other key aspects that must be remembered is that the competition also has to be on equal terms. Expecting, for instance, a 5-year-old to go and compete with an 18-year-old is actually not a fair competition. And when I say I'm using that metaphor in terms of somebody who basically is, let's say, is still need to be nurtured versus a sector that actually is, let's say, already mature. That said, I think I must also in the same breath also mention that a 5-year-old cannot pretend to be a 5-year-old all the time. The 5-year-old actually within 13 years has to become an 18-year-old, and that we have to make very clear so that this policy of nurturing does not become one of protectionism. I think that is very important. That getting that balance right is incredibly important. But overall, I think to summarize, more competition and fair competition and disruption in the financial sector, I think is what is important. And my message, primarily to fintech companies is that while they're certainly looking at MSMEs, the bottom of the pyramid, there's a lot of potential on the large corporate loans, and something that I've already spoken about. And we covered it in detail in the economic survey, which is something that the fintechs industry must look for, because I'm pretty sure that the banks will also be benefiting from it. Because if you look at in the Indian context, even private sector banks have not really figured out very well the way to do large corporate lending. They've burnt their fingers. They've been able to exit it earlier so that the burns have been less than that in the public sector space. But even they have not figured out this well. For instance, there are some banks which have basically said, we will stay out from large corporate lending because they don't have the model. But I think that is not something that we want. We want those with actually good governance, with the good ability to come up with forward-looking models to enter this, and that's where I think the fintech sector can be a big complement.
Absolutely, a complementary sector. Fintech, clearly, India seems to be at this cusp of a digital revolution that we're seeing, one that has actually got accelerated by the pandemic. And I think it has to be a joint effort on part of regulators, across the board, as well as policymakers, as well as the fintech companies that, as you said, have that perfect opportunity to fill in that gap that traditional banking has left behind. And of course, the banks coming together and also embracing some of those technological changes that are taking place. I think that in itself will lead to what we will see, a clear revolution and a clear transformation in digital, in digital payments and digital adoption. As we close this session, you've of course given a very clear message to fintech players, and that's something that I'm sure they're going to take back. But we'd love to hear your closing thoughts really on the fact that as these trends accelerate, how is the government thinking about achieving these large economic goals and accelerating them, whether it's digital literacy or it's financial inclusion?
So specifically, in this context, one area that I would want to mention, Shweta, which I think fintechs they're already getting in, but I think they can get in larger numbers, is the agriculture food processing sector. For instance, if you look at the agriculture sector, value added typically has not been very high. Growth, typically is around 3.5%, stagnates there. Because this is a sector that actually does need capital equipment, and for a small farmer, a tractor or maybe an irrigation equipment could actually be costly. But here's where, let's say, fintech comes in and pay as you go models, where or maybe leasing of equipment, using again the ability to make small recurring payments, using the fintech. These can be really beneficial, because one of the problems in the Indian agriculture area has been that the lands are very small, and as a result, the fixed cost that is required in being able to buy a tractor or some of these equipment, the small farmer does not have that ability to do so. There is as the economists say, there's a market failure there. But that's where I think fintech can come in with leasing equipment and maybe providing credit for some of these pay as you go. Also taking into account the seasonality of cash flows in agriculture. This is something which again the data-driven models can enable. So with a lot of reforms happening in the agriculture sector, what the government actually is really looking for is for these fintech startups to come in large numbers and really enable these for storage infrastructure, so that food processing sector can take off very well. Warehouses, and all these are areas where really the fintech and the private sector can come in with the opening up that the government has done. A last part, I think, which I would also highlight is the entire the labor sector. Again, with the enormous reforms that have happened. Again, this is one area where typically there are market failures. There are employers who want to hire, let's say, good people. Some of my friends sitting in Bombay, Delhi, etc. And there are at the same time people in UP, Bihar who also want to come and work. So what is happening is there is basically this sort of buyer and seller not coming together. And here's where fintech platforms, I think, can come together with because many of these, migrant laborers will want to also repay money or send money back to their families. And such recurring payments can really be enabled. These are two key areas where I think the government is really looking to push further because, these will, really enable, a lot of growth and job creation, because the primary and secondary sectors account for a lot of employment in the economy. And the fintech overlay on these two, I think, can really help in job creation, in thereby demand creation, and finally also generate sustained growth in the process.
All right, I think very, very interesting ideas as well as trends coming from you. Investors like Sequoia Capital have obviously identified fintech as a major area where we believe that there will be continued growth, continued momentum, continued buzz and activity. And I think we're very happy to know that the government, as well as policymakers, regulators, are here to support the growth of the fintech industry, and we are keenly watching all the developments that are taking place in this space. But thank you so much for your time, CA. This has been a wonderful session, and I'm sure everyone who watched it has really had a lot of key takeaways from your thoughts and insights. Thank you so much for your time on Razorpay FTX.
Thank you very much, Shweta.